This is a field about problems and solutions. The next problem is a big one. It affects coastal cities all around the world. Tonight you'll hear about how it's affecting our city. Julia Ruggiero Ruiz will present on flood insurance, climate change in New York City.
Good evening, ladies and gentlemen. I'm Julia Ruggiero Ruiz, and I'm presenting on behalf of my class and our advisor, George, our project on insurance, climate change, and flood resilience in New York City. In New York City, most properties are uninsured for the risk of flood. An estimated 6 out of 10 properties at greatest risk of flood are uninsured. And of those who are insured, the insurance premium may not accurately reflect the risk of flood. Some portion of the insured properties may also be underinsured. The problem of properties at risk being uninsured or underinsured is reflected in varying extents through different kinds of properties, such as the residential, the middle commercial, and the large commercial market. With climate change, flooding is expected to increase. Sea level rise, higher storm surges, more intense and more frequent storms are expected to exacerbate the problem as the flood zone grows and expands inland. The New York City Panel on Climate Change has an estimate on sea level rise from climate change alone. A catastrophic storm that could flood New York City that is supposed to happen once in 100 years may occur approximately 4 times as often by the end of the century. Continued development in New York City will also contribute to the increasing risk, especially with development along the waterfront. New York has more miles of waterfront than 4 major cities combined: Chicago, Seattle, San Francisco, and Portland. Estimates of the economic damage to New York alone could be compared to the estimated damage that a hurricane like Katrina could have cost all the Gulf states. These two forces of climate change and economic development work to increase flood risk. The City of New York understands these risks and is looking for a strategy that accounts for 2 things: climate change and economic development. Knowing that climate change and economic development will continue to increase flood risks, our client, the Mayor's Office of Long-Term Planning and Sustainability, has tasked us to fill an information gap on the flood insurance market. We were asked to examine the flood insurance market and market penetration of flood insurance for the city's properties at risk. Flood insurance premiums offer a price signal to policyholders about the risk that they face, and they provide an incentive to undertake flood protection. Flood insurance can also support economic resiliency by providing a financial mechanism for communities to rebuild after a disaster. Our client wants to know how to engage the insurance industry to find out how insurance can help promote flood protection. Filling this information gap on the insurance market could be the first step toward our client and the insurance industry working together to increase New York's resilience to current and future flood risks. To begin analyzing the flood insurance market, we divided the class into 2 teams. One team to focus on the National Flood Insurance Program, or NFIP, which is a federal program, and another team to focus on the private insurance industry. Both teams undertook a literature review of NFIP manuals and reports, academic reports, and other literature relating climate change with insurance. We also conducted extensive interviews of insurance company representatives, banking officials, government officials, and other experts. We analyzed and synthesized the information that we gathered, and we will be presenting this to our client next week. There are 2 main providers of flood insurance: the NFIP, the federal program, and private insurance. We conducted a market analysis to understand the current market size and the flood insurance penetration rates. The market was divided into 3 distinct segments: residential, middle market, and large commercial industrial. For each market segment, we examined the available insurance products and tried to get an accurate picture of the market penetration based on a combination of research and interviews with relevant stakeholders. A property in the residential market could be a home in Staten Island or an apartment in Manhattan. Both could be in a flood zone and could be equally at risk. The government-run NFIP dominates this market. If a property is in a flood insurance is a flood zone and the owner has a federally backed mortgage, the purchase of flood insurance is required. We found that banks do enforce this requirement. The problem of properties being uninsured, however, is really most acute in this segment, despite the NFIP requirement. We estimate that only 40% of this market is insured against flood. So where flood insurance is not required, residential property owners do not have it. Another fundamental problem may be that property owners in a high-risk area seek more insurance. The private insurers cannot price for this high risk, so that the high-risk pool gets even smaller. Eventually, the private insurer cannot set a price that is sustainable, given the small high-risk pool. The problem remains, although the private insurance industry does play a small role by offering additional insurance to supplement an existing flood insurance policy. The middle market comprises commercial and industrial properties. The NFIP offers flood insurance products to this middle market with a coverage of up to $500,000. We found that as of December of last year, there were over 1,000 NFIP policies in force. When you think about the size of the middle market and all of the small commercial and industrial properties in New York City, this is not a very big number. We also know that private insurers offer products to this middle market. It was difficult to determine the market penetration of private insurance in this market segment, as industry information is proprietary. The large commercial industrial market comprises properties with coverage of over $1 million. In this market, we found that many properties are insured. The NFIP plays a small role, offering the same coverage of up to $500,000 to these properties. But the private insurance industry dominates this market. We found that coverage of more than $25 million often requires more than one insurance company to insure the property. We also found that flood insurance is not a distinct product. Flooding is covered as what is called all-risk policies, which include other risks such as earthquakes and hurricanes. In this market, the extent of coverage is a function of supply and demand, affordability, and engineering evaluation of risk, a business decision about the amount of risk an insurance company is willing to cover. Having analyzed the market segments, the emerging picture is extremely complex. Various sectors are inextricably linked and cannot be changed independently of each other. We also found that gathering information on the private insurers challenging, as private industry information is proprietary. We have this flood insurance market, where we have the problem of uninsured properties. We have the governments at both levels trying to solve this problem of uninsured properties. And then we have the insurance industry that both tries to address the solution but is also part of the problem. Then we have the reinsurance industry, which determines the extent to which private insurance firms insure for flood. It seems that reinsurers have largely turned away from the residential market for flood insurance because of obstacles that prevent the industry from spreading and pricing risk accurately. Then we also have the increased risks of climate change and economic development acting on the problem as well. We asked insurers if they were looking at climate change as a factor in the price of insurance, and found that there are efforts to develop models that incorporate future scenarios, including flooding from climate change. We do not know, however, if the results from these models will be considered in flood insurance in the near future, or if it will be projected out further into the future. Our next step is to present our findings to the client so that they can begin shaping policies to address flood risk. We have stepped in to fill the information gap on the flood insurance market. We have collected information on market size, on how the NFIP works, the role of the private and reinsurance industries, and we also gathered information on available insurance products. And we also have the market penetration of flood insurance. We recommend improving public education on flood risk, perhaps particularly particularly targeting the residential segment where the biggest problem lies. We recommend further research on establishing the market size at risk and improving communication with the New York City agencies and the NFIP. To date, there is only one city agency that coordinates the NFIP. So utilizing the capacity of other city agencies would complement a further analysis on the market size at risk. We have built the foundation of this market analysis and recommend conducting a more comprehensive market analysis to adequately help New York prepare and manage for the increasing risk of flood by mitigating its flood exposure on a significant scale. That concludes our presentation. Thank you for listening, and I'm now ready to answer any questions. No questions. Great.
That's a challenge. Are there any ways of comparing what happened in New Orleans and under Hurricane Katrina and what could happen here in the city?
Are you saying like a climate change scenario?
Are there any ways of addressing the questions in relation to the lacks that were present when Hurricane Katrina struck?
We did actually start to look into best practices, but our client was really focused on filling the information gap on the market that was particular to New York City. So our research is focused on that. Yes?
Are there any other drivers for requiring flood insurance aside from requiring it for mortgage? Is there any other sort of regulatory requirements that would be able to increase insuring?
We asked the same question, and unfortunately the answer is no. The only requirement is that federally backed mortgage requirement. Yes?
For the residential market, does the insurance pertain to both renters and owners, and what would be the penalties if they choose not to have insurance?
Okay, so the way it works is in the residential market, the property owner is the one who purchases the flood insurance policy, and each tenant or each apartment owner could buy a policy that covers the content. So everybody there is eligible for the flood insurance. So you would be required if you were the property owner, and as an apartment or a tenant owner, it would be in your best interest to get contents coverage.
And what about penalties if they choose not to have insurance?
If you have a federally backed mortgage, there are penalties. They will force place insurance on you, which means they'll take the most expensive policy or whatever policy and make sure that you have it, because that's a requirement. So yes, there's that penalty.
Time for one more.
Yes?
In your interviews with insurance industry people, did they give you any idea of what they would need to make it more palatable for them to get into the residential, a smaller segment?
That's a great question, and one of the things that we found was that the NFIP was actually a big obstacle to this. Some of the private insurers told us that the reason they couldn't compete for the flood insurance at the residential market was because of the NFIP.